Hi everybody, this is Lara with your end of the week video for gold for the trading week ending Friday 29th of November. Happy Thanksgiving everybody to all of our members in the United States. I'm going to do some classic analysis first this week and show you why my main Elliott Wave count is bearish. I'm expecting next week the downward trend to resume. The Elliott Wave target is at 1348. The target calculated from a triangle is at 1431. So let's have a look at the monthly chart now that we've got a candlestick for November to have a look at. But first, let's go back and look at the all-time high for gold. I think this is September 2011, and this upward movement ends with a vertical slope and it ends with really strong support from volume. This is a really normal high for gold. This is a normal look for gold when it reaches a high. The first downward month is a strong bearish candlestick pattern, not quite an engulfing pattern. This is a dark cloud cover, but a really strong one. It has some support from volume, but it's weaker than the previous upward month. And then it's followed by some choppy sideways movement, and within this movement, here's the next strong downward month, and it has relatively weak volume. And so just keep in mind that this did turn out to be a very important major multi-year high for gold. This downward movement here starts out with relatively weak volume. It's not until we get into this downward month that volume really starts to actively push price lower. So up until this month, price here was just falling of its own weight. It had to overcome support for energy to be released and then volume to pick up. As volume fell down here, as price fell here, volume also fell, but eventually the low wasn't seen for some years yet, back down here. And now gold has been moving sideways here, overcome very strong multi-year resistance, did so here with support from volume, and now found a strong upward movement here, a near vertical rise at the end with good strong support from volume. But then now we have a bearish candlestick pattern, a dark cloud cover, not a very strong one, but definitely a dark cloud cover pattern. It has reasonable volume, but not stronger than the month before. Looks like this, doesn't it? And now we've got another couple of months, this month a downward month with a lower low and a lower high, but not strong downward movement. And it comes with weaker volume. Recall what happened back here. Just because volume is a little bit weaker here doesn't mean that this has to be a counter trend movement. We could have seen a trend change back here. There is a candlestick reversal pattern at the monthly chart level. It did have reasonable volume. If you wanted to go back into this chop and cover everything that happened up afterward, if you hadn't given enough weight to what happened in this first month after that major high, you may have been convinced that this was a pause within a continuing upward trend and not the start of a new downward trend. And so I am going to still continue to give reasonable weight to this candlestick pattern, which has reasonable volume. There's something else quite concerning for bulls in this chart. Price has made a good strong new high above these highs here, but on balance volume is essentially flat. It has not confirmed those highs in price. Whereas here, as price made higher lows, on balance volume has made lower lows. This low here from price corresponds with a major low from on balance volume. The on balance volume profile is actually quite bearish. On balance volume is constrained at the monthly chart level with resistance and support. A breakout would provide a signal that has not happened yet. ADX at the monthly chart level indicates there is still an upward trend in place. This is a lagging indicator, and on this chart it is based on a 14-month average. And so it's not going to be for over a year that ADX may catch up and eventually indicate a new trend if it does. But with the data in hand at this stage, it does indicate an upward trend. But on balance volume sounds a strong warning that that may not be sustainable. ATR has been declining for many years. It may be starting to show some increase, although now it seems to be flattening off. This is not enough to say that this multi-year trend has changed though. RSI reached overbought at this very important high but it has not exhibited any bearish divergence. It's back into neutral territory, and stochastics is returning to neutral. MACD is full bore bullish. What about the weekly chart? At the weekly chart level at this high, we also have a candlestick reversal pattern, and it has some support from volume when we compare it to the week immediately prior. We have a couple of long upper wicks, so this is a dark cloud cover, bearish candlestick reversal pattern, this one here. We also have a couple of long upper wicks. I pay reasonable attention to candlestick wicks. These two in conjunction are bearish. This second week here has active push from volume, pushing price lower. And then a few weeks ago, we got a really strong downward week with very strong volume. This is very bearish. Apart from the previous highs, the recent movement after this high is strongest in downward weeks in terms of volume. The volume profile for this piece of movement remains bearish. These last 3 weeks at this stage look like a pause within a new developing downward trend. On balance volume has made its high back here. There's no bullish divergence at the short term for the short term picture here. The last signal it gave was a break above very weak resistance, and then a test, and now another test of support, which was prior resistance. This is a very weak bullish signal, not enough to change my overall bearish view. ADX of that previous upward trend at the weekly chart level reached very extreme. When ADX reaches very extreme and RSI is deeply extreme, and then we get a bearish or bullish candlestick reversal pattern, we then give that candlestick reversal pattern weight, and so that's what I did back here. And I've been expecting some downward movement. That's what we get in. ADX is now declining, saying the previous very extreme upward trend may have ended, but it's not telling us there may be a new trend yet, and there has not yet been a cross of the DX lines. Again, ADX is a leading indicator. It is based upon averages. ATR, after price overcame resistance and energy was released, showed a strong increase. Now prices got some choppy overlapping downward movement. ATR is showing some decline. This is actually really normal behavior for this particular market. When it's in a new trend, it will start a new trend with choppy overlapping movement before it develops strength, and then it explodes at the end. So this is absolutely normal behavior if there is a new downward trend for this market. Sadly, it's also normal behavior for a correction. The key is the reversal patterns and volume to identify which is which. We've been over RSI, stochastics entering oversold, and MACD bearish, but not fully so. What about the short-term picture? It looks like there was a triangle pattern here. There was a downward breakout which had good, strong push from volume. Price closed well below the support line of this triangle. I'm calculating the base of the triangle, adding that to the breakout point to calculate a target at 1431. This looks like a normal bounce and back test of resistance, which was previously support, the lower end of the triangle, and now moving down and away. It's possible there could be another test. Friday's upward session has a close very near the high for the session and a little bit of support from volume. When we compare it with the session immediately prior, there may be a little bit more upward movement when markets open next week. But overall price is moving sideways, and volume is now overall showing some decline as price moves sideways and a little bit higher. And so this looks like a counter trend movement, and this looks like a new trend. It's got good push from volume. On balance volume at the daily chart level also is making new lows prior to price. Price has not made a new low below this point back here, but on balance volume has made new lows below these prior points. We read on balance volume as a leading indicator. Where it leads, price may follow. RSI is well into neutral territory. There is plenty of room for price to rise or fall. At the highs back here, there is a really strong bearish candlestick reversal pattern and a shooting star back here. This candlestick reversal pattern at the daily chart level is particularly strong, and it encompasses all of these several previous daily candlesticks, and it has good, strong support from volume. When a trend reaches that extreme and we see such a strong reversal pattern, we should give it a lot of weight, and I have. ADX is again declining, indicating no clear trend. If it does increase again, it will again indicate a downward trend, and this is the strongest signal ADX can give when it comes from low levels and rises up from below both directional lines. That tells us a new trend is in its early stages. And ATR is declining again. That is absolutely normal behaviour for this particular market when it's in the early stages of a possible new trend. Also normal behaviour for this particular market when it is within a consolidation or counter trend movement. And the difference is what happened at the price, where price reversed, the candlesticks and volume. So this looks more like a new downward trend than a pause within an ongoing upward trend. But I have Elliott wave counts for both scenarios. Let's go to that now. So overall, my classic analysis favours this Elliott wave count, which expects there is a major high for gold back here, and that gold is in a new bear market or a continuation of the old bear market to complete a really big, obvious three-wave structure labelled A, B, C. When you look at this movement from the all-time high from gold down to the slowdown here, it looks like a five-wave structure, and if it is a five-wave structure, that can't be the end of the bear market. Bear markets are interrupted by counter trend movements, upward movements, for a B wave bounce. This is a really big one that lasted several years because the bigger picture at the monthly chart level is a huge zigzag, A, B, C. If C is beginning here, then I'm not going to calculate a target for you until my bullish Elliott wave count is invalidated with a new low below the confidence point, because my target is going to be quite low and I will expect quite a lot of negative commentary about that. So I'm going to wait until the bullish wave count is firmly invalidated before I do that. Draw this channel on weekly charts, copy it over to daily charts. In coming weeks it may become important. If there is a final bounce to a final high, this may provide resistance along the way down. I will expect a bounce to happen about support here. Draw it from the start of this bullish bounce to this low here, place a parallel copy on this high here. This Elliott wave structure is a double zigzag. B waves, and I'm labelling this as super cycle degree for wave B, can subdivide as more than any one of more than 23 Elliott wave corrective structures. They exhibit the greatest variety in structure and price behaviour. It's essential when you think a B wave is unfolding to exhibit flexibility and patience. This structure is a double zigzag. It has a very good fit. W, X, Y. Pay close attention to this movement. This subdivides best and looks best as a 3, A, expanded flat for B, C. If we accept that this is a 3, and if we accept that the bear market to this low down is a 5, then we have to accept that the bear market is incomplete. Let's take a look now at the daily chart level. We're into supercycle B, this high back here, and the start of supercycle C needs to begin as a 5-wave structure down. For the first 5-wave structure, I'm going to label intermediate wave 1, and within it, the amount now may be a series of overlapping first and second waves. This is exactly how gold begins its new movements. 1, 2, 3, 4 overlapping first and second waves may be complete. I am leaving the invalidation point up here though to allow for the possibility that this could be a continuation of minor wave 2 as some kind of expanded flat or combination, and it can't move beyond the start of 1. The series of overlapping first and second waves is absolutely normal for a new movement in gold, and here's a perfect example of what I'm trying to explain. Here is 1, 2, 3 overlapping first and second waves. Gold then accelerates through the middle of the third wave and explodes at the end of the third wave. That is absolutely typical behaviour, and it gives gold's impulses a nice curved look to them. Have become quite comfortable with labelling an impulse and expecting it to have this curved look from gold. I expect that this may be what is developing to the downside. There will be a curved look. Look out for the end of intermediate 3 particularly. I will be expecting an explosion in downward movement. It could also be seen at any of one or more the ends of these third waves. At the hourly chart level, here is the last first and second wave, and so at this time frame we can add another. Now we have 1, 2, 3, 4, 5 overlapping first and second waves. A downward breakout should be imminent. For the very short term, it is possible. I could relabel microwave 2 as a double zigzag. It could continue higher. It may not move beyond the start of micro 1. I'm leaving the invalidation point up here to allow for that possibility, to give the market a bit of room to move. At the daily chart level, this wave count is identical to my first daily chart up to this low here, and now I'm considering what if the second zigzag, cycle Y, in super cycle B is incomplete. What if it's unfolding A, B, C? This wave count's a little bit different to the one I showed you last week. Here I've relabeled primary wave B thanks to a member, Dreamer, who posted a chart and comments with this idea. It could have been a single zigzag. A, running contracting triangle for B, C. A and C are close to equality. I've changed it because this allows for the possibility that primary B may not be over there and could continue lower as a double zigzag, and it would still be a fairly common structure for a B wave to be. But if it's over here and you think that the bull market for gold is resuming, then primary C needs to subdivide as a 5-wave structure. 1, 2, 3, 4, 5 needs to unfold. The target for primary C is to reach 0.382, the length of primary A, because about that point price would again find resistance at the upper edge of that big channel I showed you how to draw at the weekly chart level. At the weekly chart level, this is a bullish wave count for gold. It is possible to see that big bear market as a multiple zigzag structure, so the bear market could have been over there. It doesn't really look like a good 3-wave structure, and at this time frame, particularly at the monthly chart time frame, gold's bear markets do tend to have a pretty good 3-wave look. This one wouldn't have, so that's a little bit of a detraction. But, and again, for longer standing members, I am repeating myself, but I have to say it every week for newer members and viewers. The biggest problem with any bullish wave count for gold at this time is how you see this first move up off this important low in December 2015. If you were having any bullish Elliott wave count for gold, it's impossible, or at least I have not found a solution for this problem. This needs to be a 5-wave structure. It can't be a 3 if you're expecting there's a new bull market for gold. And the problem here is the disproportionate 4th and 2nd waves. I was showing you on a daily chart that curved look for gold's impulses, and there are 2 more good examples here. I was showing you for this here. That's a curved look for gold's impulses. Here's another curved look for an impulse. This one's a C wave, this one's a first wave. Here's another one, another C wave. The curved look comes because the second waves are time consuming and the 4th waves are brief and shallow. And because the movement usually starts off relatively slowly, a slow start, choppy overlapping movement, strength through the middle of the 3rd wave, explosion at the end. A slow start, choppy overlapping movement, strength through the middle of the 3rd wave, explosion at the end, strong 5th waves, very typical commodity behavior. What is absolutely atypical, especially at this time frame, this is really problematic, is for the disproportion to be the other way around. This has a 3-wave look, but it's not that normal curved look we see from gold. Primary 4 is an expanded flat. It's very wide-ranging in terms of price and longer in duration than its counterpart primary 2, which is very quick. It's deep, but it's got a much smaller range covered in terms of price. This is a very unusual look for an impulse for gold. It substantially reduces the probability of this wave count, or any bullish wave count you may have for gold. Let's take a look at this at the daily chart level, and I'll show you why this is such an important price point which differentiates bull and bear. This high is primary wave 1 within cycle 3, which may only subdivide as an impulse. Here is 1, 2, 3 is longer than 1, 4 may be complete as a single zigzag. If it continues lower as a double zigzag, it may not move into wave 1 price territory, below this price point. The data I am using for this Elliott Wave analysis comes from bar chart. It is cash market data. I will not allow for any overlap at all. If we see a new low by a fraction of a cent on a tick chart, this wave count will be invalidated. You can only allow an overlap between 4 and 1 in an impulse with futures data, and even then I've seen too many people publishing work they call Elliott Wave online, which relies on that to make their wave count work. Don't allow for an overlap between 4 and 1. It's really unusual, and especially for cash market data, it should never happen. That rule is absolute. And that's one of the nice things about Elliott Wave. All of the Elliott Wave rules, with one sole exception, are absolute. If 4 is over here, and you have a bullish bias for gold, if your own personal analysis supports a bullish wave count, you may choose to use this with its invalidation point, identifying risk, and its targets to identify possible reward. The fifth wave needs to be a 5-wave structure. We may have incomplete 1, 2, and then 3, 4, 5. At the hourly chart level, here's the end of minor 2 with an intermediate 1, and now minute 1, 2, and now minuet 1, 2, and now subminuet 1, 2. Although I'm going to leave the invalidation point down here to allow for the possibility that this movement may be a continuation of minute 2, it may not move beyond the start of 1. This wave count now expects there's a series of 1, 2, 3, 4 overlapping first and second waves with an upward breakout expected. That's all from me this week with your gold analysis. I hope all our members are having an awesome weekend.